Welcome to Market Radar. We're not investment advisors, security analysts, or brokers. The following information is strictly for entertainment and educational purposes only. None of the information here is intended as a buy or sell recommendation. Welcome to another episode of Market Radar. It's May 8th, 2022. Let's get started with the year-to-date performances. S&P is down 13.39%, NASDAQ down 22.27%, Russell down 17.92%, and Dow Jones down 9.43%. All indexes are bearish trend on our model still. Our regime matrix has 71% chance of risk off, as it's been for quite a while. Stagflation odds still really high up there, actually increased from last week up to 39.9%. And let's get on to the earnings calendar. Next week, not too heavy. Not earnings calendar, economic calendar. We've got nothing market moving Monday and Tuesday. Wednesday, pretty big day with CPI. And then we've got EIA petroleum status report and then a treasury statement. Thursday, we've got jobless claims, PPI final demand, EIA natural gas report, and Fed balance sheet. And Friday, we've got import and export prices, consumer sentiment. So that's CPI on Wednesday. That's the important number. You know, everyone's looking at inflation right now, waiting for it to top. So that's going to be a hot topic. Keep an eye out for that. This past week, ES has been pretty range bound and moving downward as expected from our risk-off regime. This is what we've been warning you about. We've had that big ripper of a day on the 4th, squeezing some shorts out that came in late. We're trying to warn you guys about this. You know, don't be entering positions late. If you're not short already, it's too late to enter now. And right now, futures are open as we're recording this. We had a little touch of the bottom wick on the 2nd. Haven't broken it, so we're still range bound. We'll see how we do next week. We may go lower. We don't know. But just watch out for some rippers because, you know, stagflation is notorious for squeezing shorts and squeezing longs as well. And moving on to ZN, really not much to say here. It's just burning down, just like we've been saying. Pretty much every single podcast we've had, we've been saying ZN's going to be going down, and sure enough, it is. We're not expecting a reversal of this until real yields top, which we're expecting real yields to go quite a bit more in the positive. They recently went positive, I think, right? Is that right, Gamma?
Yeah, so real yields across the average duration of U.S. Treasury. So if you were to take all the durations, average them out, that average is positive, and the 10-year is positive as well now.
Okay, so we're finally in positive territory.
Yes.
But we're expecting to go quite a bit up there. You've got to be decently positive for deflation to kick in, which
Right.
it's pretty much inevitable that deflation is going to kick in unless if somehow growth just makes an insane recovery. But, you know,
Yeah,
it's
that's
not
high,
likely.
that's
Highly
highly
unlikely.
unlikely. I guess the best analogy to reference what you're saying to is the roller coaster, right? We're at the top. Odds are we go forward, not backwards, and forward is deflation. Backwards is some positive growth environment, but it's highly unlikely we see that. So
Yeah, exactly.
yep.
So we're expecting deflation. That's when we will see a reversal in bonds. So
Right.
everyone's trying to catch a falling knife right now. We're just waiting for our system. Our system catches regime shifts ahead of time. So there's no reason to front run it. We're just waiting it out. This podcast, we want to talk about inflation. Inflation's been the hot topic, inflation and stagflation. We already talked about stagflation, but we decided to talk about inflation this time. And let's see what you have for us, Gamma.
Right. So let's start this off by um, defining what we're talking about when we say inflation. We're not talking about our regime model inflation. We're talking about the actual inflation being the rate of change of the consumer price index. As you know, we have a regime that's inflation where GDP is rising and CPI is rising. This podcast is dedicated to the CPI component of our models but not of our models, what we look at for what the market's pricing in and a lot of other macro analysts models. So let's look at the inflation rate on a year over year basis. The last reading last month was at 8.5%. I drew a couple lines on the chart here. As you can see, the 1980s peak is 14.8%, and the GFC lows is negative 2.1%. So let's understand what this means.
Well, first
What
off, this is the number that we're expecting on Wednesday, right?
the number are you
The
talking about?
CPI print
Yeah,
that we're
yeah.
expecting on
Exactly.
Wednesday.
Yes,
That's
yes,
this
yes,
chart right here.
yes. That's the yes, exactly. So, TradingView defines this as the inflation rate. This is basically the year-over-year change of the consumer price index. So, um, realistically, the consumer price index or inflation that everyone's talking about is on a rate of change. It's actually a basket that's released on a monthly basis with a price. And we get these numbers 8.5% inflation year over year, or the month over month numbers, or quarter over quarter numbers from the basket's values in the preceding months, quarters, or years. So all this is a reading of this year's value versus last year's value, right? So that's really where you're getting the year over year change. So let's talk about the two types of inflation that there are in this chart, right? So you look at a chart, you see inflation, you just think, oh, um, inflation at 8.5%, that means things are getting more expensive, right? But there's two types of inflation. And I think that's very important that we talk about this in this podcast because, as you know, when in stagflation, it has a component of CPI rising and growth falling. Deflation, the next likely regime, is going to be a peak in inflation or CPI, where CPI is falling and growth is falling simultaneously. So, what has to happen? Now, a lot of people say, well, commodities, right, have to peak, aka we're going to go short commodities because it's peak inflation. This is where we're going to define the two types of inflation. So, there is demand pull inflation and supply side inflation. So, demand pull inflation is basically inflation that's initiated by an increase in demand. So, more demand comes, limited supply, inflation happens. That's simple. Now, supply side inflation, right, is inflation caused by an increase in costs, disruptions of supply chains, etc. What we had, what the market was showing us coming out of COVID was we had this demand pull inflation. There was just so much demand. Now, the supply chains were affected, but the demand was there, right? The demand was there to really emphasize that demand, that pull on demand, which push prices higher. I mean, you saw it with everything from NFTs, right? Just everything. Like it was
Yeah,
just
and
all
that
inflated.
was just spurred by helicopter money, basically,
Right,
right?
exactly. And now, yeah, that's pretty much it. And now what we're left with is this supply side inflation where the demand is kind of it's evaporating, right? And the supply chains are still affected. So now you have this issue where like the supply chains aren't able or they can't meet the demand of the average demand of society. So coming out of COVID, there was this hype demand, which basically covered up the supply side inflation, right? Because a lot of things were basically marked up as, oh, there's just, you couldn't get a car, right? Cars were hard to get because there was so much demand, right? Now we're left with this issue of we can't produce enough cars. Even though the demand is falling, used car market's falling, but dealerships still don't have cars. We're left with this supply side inflation. Now, the reason I bring this up of demand and supply side inflation is when you look at commodities, it's very interesting when you look at the the um, the different types of commodities. So, for example, on the screen here, we're going to pull up lumber. Lumber doesn't look too hot, right? I mean, we're back in bearish trend. We've been in bearish trend since early April. Doesn't look too hot. But now if we pull up crude oil, looks a lot better, right? And if we pull up I think this is soybeans, looks a lot better. Maybe corn might not look. No, even corn. Corn looks a lot better, right? Than lumber. Now, why is this? The main reason is commodities are materials, right? But they're also like food. So you have these supplies and you have food.
So it's kind of
It's
like necessary
right,
commodities.
right. Yeah. So like if you want to simplify it down to that level, I think I was going a different way, but I'll go your way, right? So you have commodities like copper, which is used in building, right? So we have copper here, and you can see copper's not looking too hot either. You have building growth surrounded with copper, whereas necessities, life, everything is like food. So soybeans, corn, right? And I mean, we need oil to heat homes, to move around. Like you need oil for your
Yeah, it's
car,
basically a
right?
necessity, like a
It's
survival
basically
necessity.
yeah. In some way, I mean, some wouldn't consider it a survival necessity because obviously there's a lot of like solar infrastructure in some places, but in reality, a lot of America runs on oil. Like it's much, it's just what it is, right? So the oil is going to have the sustained demand. Also, there's a problem with how we're sourcing oil. I mean, we can go this whole political angle, but in reality, um, there's necessity there's commodities that are vital for our society to function, and then there's commodities that you don't need for life, right? Like food you're going to need. So this is where um, you're seeing a bid for the necessities, and you're starting to see a fade for those things that are not luxury but not required for life, right?
So kind of
So
like
like
the things that have a growth component, like you
yeah, and
said,
that's
with
a
like
good way to put
copper
it.
and lumber, right?
Right,
Copper
right.
used for manufacturing, lumber used for building. So if growth is decreasing, yeah, those are also affected by inflation. Commodities are always affected by inflation, but they have a growth component as well that's pulling them back since we're in a negative growth environment, right?
Right. And and if you know anything about stagflation, those that are listening, stagflation is a very positive historically it's a very positive regime for commodities. The problem with this is in the last 15 years or so, um 16 years or 15 years, the stagflation has basically been cut short and had very harsh pivots to deflation. What I'm trying to say is being long commodities is very hard in stagflation because the um the reaper of deflation is just around the corner and you don't know when. So you get long these commodities and it's a complete 360 or 180, I'm sorry. When you're going you're outperforming with commodities in stagflation to where you're underperforming greatly in deflation because things get absolutely destroyed. Obviously, remember commodities at the end are an inflationary component. Um, Oil is one of the biggest baskets in the in the consumer price index. Energy, I should say, not oil, but energy. So, if this consumer price index or aka inflation is falling, well, commodities are going to fall as well. So, the big issue here is that at any point in the next 3 to 6 months, depending, the Federal Reserve can crush commodities. Now, the problem that we're going to have where this peak inflation um, ideology comes in is peak inflation for what? Peak inflation for growth components or growth component commodities or peak inflation for all commodities in general? Because remember, you can have this supply side and like demand pull inflation is a bit different, right? Demand pull inflation is if you crush demand, you cure the inflation issue. If demand gets crushed, you fix the inflation issue. The problem with supply side inflation is like even with the demand falling, we're having a problem with inflation because the supply chains are still not yet repaired. I mean, you can look at a company like Nvidia, believe it's Nvidia. They said they're going to suffer supply chain problems going all the way out to like 2024. Like
Yeah,
these things
so
aren't easily fixed. So even though you have demand falling, inflation is going to remain sticky. I mean, you can look at things like diesel. I think we have diesel here. Diesel is went parabolic last week. I mean, diesel right now, as of the close, as of it's the market open, right? Is diesel market open? Yeah. So it is currently trading higher than it's trading back basically at 2008 peak. It is at earlier this week or earlier last week, mid last week, it traded higher than it did in 2008. Crude oil, on the other hand, is still struggling to recapture the 2012 highs. In
well,
2008,
so what does that diesel price mean?
well, diesel is used by diesel's used by a lot of construction, right? Construction trucks and stuff like that, and transportation, big trucks. So this goes back to not only diesel being expensive, but things like fertilizer being expensive, going parabolic, right? Fertilizer, all these transportating infrastructures from the creation of food to the transporting of it to the shipping costs, all these things are rising, right? Because it's so hard to get the food. We're having fertilizer issues, then we're having chemical issues to make the fertilizer. So the cost of food is going up. The cost of everything along the chain has to rise. You understand? Because the profit margins, like the farmer's got to eat too, right? The farmer can't just make food for free.
Yeah.
So all of these things get reflected, and the farmer's not the one that's saying like, "Oh, I'm going to just raise food prices." And this is where the political angle gets injected, where they think that farmer or companies or material produce commodity, or I should say, companies that produce commodities are price gouging at their own will. This all comes back to the direction of supply and demand. So if we have a lot of supply and no demand, it's very easy to find these material. Like if you, let's just say you're a corn farmer and there's a ton of supply of fertilizer, it's cheap. You can make cheap corn. You don't, you can have your profit margin of, let's just say, let's call it 10%. I'm not a I'm not a farmer expert, an expert in farming, or I don't know the profit margin. I'm just guessing. This is hypothetical. It's 10%, right? You have this profit margin of 10%. At a profit margin of 10%, by the time it hits the store, it might be reasonable. You might be, oh, okay, no big deal. But that 10% profit margin, right, is what the farmer uses to live himself. You know what I'm saying? Like that's after he runs the farm. He has to live too. But let's just say the cost that he takes to, or the cost that to acquire the goods to make that corn rise significantly, and that 10% profit margin gets crushed down to 30%. He can't live anymore, but he's got to live to farm, right? This is a necessity. Without, if he dies, or he can't sustain his life, or he can't sustain his well-being, well then the farm ain't gonna work. So he's got to get that profit margin somehow, right? Well, guess what happens? He pushes that profit margin up, and that flows throughout the chain all the way back down to the consumer. This is how price hikes or supply and demand works from an inflationary standpoint. And I think that's what a lot of people are not paying attention to when they see gas prices so high. They see these, pasta, all these things going up in price. They think that it's greedy corporate America, but there's probably a greedy aspect to it, but it's not just that vanilla.
Yeah. So since it's so sticky and ingrained in the supply chain, like it's not just a quick fix, right? There's so
Right.
many components to it. What has to happen for it to reverse?
Well, that's a good point. So demand pull inflation, you could essentially there's some angles and viewpoints out there that you can print your way out of demand pull inflation, right? Because you have this you have an increase in aggregate demand, right? So you just the supply isn't there, so you can basically print supply, right, and to demand. Well, that's pretty much what happened in 2020. So I guess that theory is proven incorrect, right?
Yeah.
You
So
basically
they basically
so
used their last bullet right there.
right, and if you think about it, there's a lot of people on Twitter, especially, that say we need to print more money to exit to save the recession. Some of the stuff that people think about, I wish they could back it up and give me a viewpoint because I'd love to read this, and it sounds quite asinine, but again, I mean, I'm open to all opinions and ideas. I'm a free thinker, so if you give me an idea that makes sense, I'll listen. But the stuff that they say that you need to print, I think I saw a comment earlier. Was it earlier this week? I think it was earlier this week. The guy, it goes along the lines of that we need to print money to reverse the downturn in the market. I think that he doesn't understand that the market's realizing that there's no amount of money you can print to reverse the downturn. In reality, it wasn't so much printing the money, it was the Federal Reserve propping up asset prices, which is quite obvious, right? Now that we look at the market and the Federal Reserve is taking their steps backwards, the market's falling too. So it just goes to show you that this entire market was propped up by easy money, easy liquidity. That's another thing, right? We know that with rising liquidity comes, with a rising Fed balance sheet comes suppressed volatility and easy liquidity.
Yep.
With a falling Fed balance sheet comes enhanced volatility and decreased market liquidity, which is quite obvious what we're seeing. I mean, if we pull up the VIX, right, and you look back in time, you could see that we'll make this a line chart and take DDAP off so everyone can see this. You can see like going into here, and we'll pull up the and this is the this is our little liquidity index. As liquidity is going down, which is basically meaning it's conditions are loosening, VIX is very, very suppressed. And once these conditions start unwinding, getting tighter, these megaphone patterns start coming back in VIX where you're ripping up and down, and that's just market liquidity. Things are becoming less and less liquid. Another thing I wanted to touch on this in this podcast was the credit card situation in America, or I should say the credit card and the consumer loans issue. As you can see, the credit card balances or consumer loans, I'll say, hit an all-time high in April of 2022. So basically, America or the consumers all levered up right into a risk-off regime. It's almost as if like it's the perfect storm, where people think that, or maybe it's not people think, maybe people are having problems with wage increases and costs are going up, right? So they have to spend more on their credit cards.
Yeah. I feel like that's the most likely
Probable,
outcome
yeah,
because I
I
don't
know.
think, this I think people realize this isn't like the time to be taking on risk and getting levered up. People are
Yeah,
noticing rising food prices, rising gas prices. I think it's just kind of out of their control. They just need to take out loans. They need to use their credit card to pay for these price increases.
yeah, and something about this consumer loans index. It's produced by the Fed. It usually doesn't have a good time when it crashes. I mean, you have these abrupt drops. I mean, in 2008 it was a slow burn, but as you can see, the financial index. So what happened was the financial index took a shit. Basically, I mean, excuse my language, but I mean, it's 2008. Banks were going out, right? And credit cards ripped at the beginning. Um, and this is primarily because you need debt, right? Like you're in a crisis, you're gonna rack up debt, and I think that's what we're seeing right now. Um, you're starting to see the financials break down, but credit card, or I keep saying credit card, consumer loans, right, um, are rising still, hitting new all-time highs. And I think people are having an issue. I mean, I live in the Northeast, and I know that heating oil right now, we're going into May. Heating oil is $6 a gallon, pretty much. Now, 3 months ago, it was about $4.15 a gallon. 3 months before that, it was about 3.50, right?
Jeez.
So, so yeah, so but we're going into the summer season. You would think, well, in the summer season, you don't need heating oil; it's going to go down in price. Well, we're having this problem where this sticky inflation, right? This is sticking going into the summer. Now, if this sticks going into next winter season, the cost to heat your home will be up 100%.
Wow. That's wild.
So let's just say you live in a home that costs 1,500 or $1,200 a month to heat, right? $1,000 a month to heat, depending on your home size. Okay. Well, if heating oil is up 100%, now that house is going to cost you 2,000 a month. But
Do you
let's bring this
think
to a
you
more
think it has
realistic.
anything to do with people stocking up?
Uh, yeah, I mean, that's a possibility, but I don't think the bid to stock up is that high. I mean, remember, you can only stock up so much heating oil, right? Like you're gonna have a 200-gallon tank. Like if you're ordering heating oil, right? And you depending on where you live, you may have a tank in the ground, right? You may have like 1,000-gallon tank, 200-gallon tank, depending wherever you live, right?
Yep.
So if you have a 200-gallon tank, how much can you really stock up?
Yeah, it's true.
Right? You can't really stock that much up. You just 200. And let's use this analogy on a smaller level, right? Let's just say you have a homeowner, and we'll use this for example. It is mortgage, right? Let's just say he fixed rated it in COVID, and he's paying 2 grand a month, right? But let's say the heating his home in the winter is $400 a month, right? $500 a month. Well, if these prices stick till next year, he's going to be paying 50% of his monthly mortgage payment on heating.
Yeah. Not a lot of people can afford that.
That's pretty scary, and I don't think a lot of people know that's a possibility as of the current situation. You understand? Like,
Hmm.
I don't think most people are looking that far ahead because they're not even who's thinking about heating oil right now? Everyone's thinking about summer, right?
Yeah.
I mean, boating season is going to be whack. I mean, I could just tell you that. Like,
Oh yeah.
yeah,
Definitely.
that
That's
that's
gonna
fucked.
suck.
That's fucked. Yeah, that's fucked. But it is what it is, right? Like, that's just a and this goes back to how you view inflation. So what we have here is we have the 10-year break-even inflation rate. And if you don't know what this is, we've spoken about this in many podcasts where we go over real yields. This is the second component in real yields. You have the nominals, the current yield, minus the break-evens, which are indicated in blue here. And that's where you get the real yield. So long story short, the crude oil runs along the real simple. The break even in the 10-year break even inflation rate is a good indication of where crude oil is going. Obviously, a rising break even, right? A rising 10-year break even is assuming that the inflation expectation on an annual basis over 10 years is continuing to rise, right? So as this falls, it's assumed that over the next 10 years on an annualized basis, inflation will fall. So crude tends to travel well with this rate. As you can see, it seems it follows it pretty well. I mean, if there's major drops in crude, the break evens are falling. It makes sense, right? Because as we said this earlier, of the consumer price index, energy is a major component. So as we closed on Friday, we had break even still very 10-year break even still very elevated. And the reason why I bring this up and the reason why I tell you we're not long commodities is because the Federal Reserve will actively try and push down break evens, right? And the way they do that is that's their way of killing inflation, right? So by hiking rates aggressively, they're going to curb the rate of ascent of break evens, right? Over 10 years. But it's gonna be adversely affect not adverse. It's gonna be delayed in the nominals. So the nominals aren't going to be affected right away, where the break evens are, because the CPI they're basically fighting the consumer price index. Now, are they going to be able to completely crush it? I don't think so, because remember, we have this supply side inflation that's you really can't fix. So with rate hikes or whatnot, you have to like let it repair itself, let the supply chains come back online, things like that. Basically, make supplies more available, and get rid of the scarcity issue we have going on. Now, we're watching the break evens closely because we're expecting real yields to rise. And what that would mean is the current 10-year yield would stay sticky, grinding higher, maybe the same, while the break evens fall. That's how that's what would create a divergence, or an increase in real yields where the nominal goes up, or I shouldn't say goes up. The nominal widens against the break evens. So that means they both can go down, but the break evens can fall faster, or they can both go up, or one goes up and the other goes sideways and they rise faster, or one goes up and the other one goes down, right? The spread has to widen. We think the real yields widen, which is why we're watching break evens, because it's one of the only other two components in real yields outside of the regular yield you see on TV for the 10-year. So what we're watching here with real yield, with break evens, is uh, a buck and trend are starting to roll over. Now, if they don't roll over and they continue higher, well, crude commodities are going to do the same thing. But the Federal Reserve is actively going to fight this, so that's why we're not long commodities. And the chance that this starts to fall apart, we don't want to be caught mid regime shift in a commodities position where the money on commodities has already been made. You're kind of coming late to the game. We'd rather be positioned for the next move than try and catch the tail ends of this one. And I think that's where we can leave this off. What do you think, Artie?
Yeah, I think that was pretty good. Um,
Okay.
all in all, inflation, it's sticky. We don't know when it's going to end, but our model will tell us. We're looking closely at real yields, looking at crude oil. Crude oil is a big component. Energy is a big component of CPI. And yeah, keep an eye out on that.
Yeah, and another thing is, whichever way the CPI print goes on Wednesday, up or down, um, we can't tell you. We don't bet it. We're not betting this, right? We're not playing a game of spy options going into this, like, oh, CPI print up, market down, CPI print down, market up, or up, down, down. We don't know. In reality, this could be whatever it wants to be. Do I think inflation personally? I would say I would assume it's grinding higher with commodities, right? Commodities haven't buck trend yet. Why should inflation? But I'm not going to make a financial bet on such a whim, right?
Yeah.
Like our model gives us the confidence to go out there and strike hard, and it says it's stagflation. Until it says it's not, we're going to remain positioned. Almost 50% cash, riding the wave, the tail ends of this stagflation, and then when the real deflation pivot comes up, that's when we strike hard and we long the bonds. We load the lows with the bonds, right? That's the goal.
Yep.
All right.
All right. Thanks for listening.